Hey Alan, I just came across this topic called compensation strategies for corporate owner managers. And honestly, I have no idea what it means.
That is a great place to start, Raj. Compensation strategies for corporate owner managers simply means how a business owner takes money out of their corporation in a smart and tax-efficient way.
So this is about salary versus dividends kind of decisions.
Exactly, but it goes much deeper. It involves planning for taxes, retirement, family needs, and long-term wealth.
So it is not just about saving tax this year.
Correct. A good compensation strategy balances short-term tax savings with long-term financial goals.
When I look at these strategies, I feel like there should be one best answer.
That is a common mistake. In compensation planning, there is rarely one correct answer.
So different accountants can suggest different plans.
Yes, one accountant may focus on saving tax today. Another may focus on retirement planning. Both can be correct depending on the client.
So I need to think based on client goals.
Exactly. Always ask what the client wants now and in the future.
I keep hearing about something called Holdco. What is that in compensation planning?
A Holdco is a holding company used to protect profits. It separates business risk from accumulated wealth.
How does that work?
The operating company earns profits. Then it pays dividends to the holding company.
Is there tax on that transfer?
Usually no. Intercorporate dividends are often tax-free.
So money moves from risky business to safe company.
Exactly. That protects retained earnings from lawsuits or creditors.
Most people take money out every year. Why leave money in the corporation?
Because the corporation can act like a savings account.
How does that help?
If a client leaves $100,000 each year, after 20 years, they can accumulate $2 million.
That sounds powerful.
It also helps control spending because money is not easily accessible personally.
But if they leave all money inside, will they pay tax later?
Yes, and that is why we use a strategy.
What strategy?
Pay a small dividend each year, then lend that money back to the corporation.
Why do that?
Because later, the loan can be repaid tax-free.
So part of retirement income becomes tax-free.
Exactly. This creates long-term tax flexibility.
I hear about eligible and ineligible dividends. What is the difference?
It depends on how the corporation was taxed.
Which one is better?
Eligible dividends usually have lower personal tax.
So always use eligible dividends.
Not always. You must consider things like OAS clawback and total income.
So it depends on the situation.
Always. Never rely on rules of thumb.
Why would someone choose salary instead of dividends?
One big reason is RRSP contribution room.
Dividends do not create RRSP room, right?
Correct. Only salary does.
How much salary is needed?
If RRSP limit is $26,010, salary needs to be around $144,500.
That helps reduce taxes too.
Yes, but only if the client actually contributes to RRSP.
What changes when a client is near retirement?
Planning becomes more complex.
Why?
Because of CPP, OAS, RRIF withdrawals, and corporate income all combining together.
What is the biggest risk?
Large RRSP balances causing high forced withdrawals and OAS clawback.
What can we do?
Start withdrawing RRSP earlier to reduce future tax burden.
What if two partners work differently but own equal shares?
Dividends must be equal, so that creates a problem.
And how do we fix it?
Use salary for the person doing more work.
And dividends remain equal.
Exactly. Salary reflects effort. Dividends reflect ownership.
Is RRSP always the best option?
Not always.
Why not?
Because RRSP withdrawals are fully taxable.
What is the alternative?
Take dividends and invest personally.
What is the advantage?
Only investment income is taxed, not the full withdrawal.
What about CPP? Should clients always contribute?
Not necessarily.
What is the alternative?
Use TFSA by taking dividends instead of salary.
How does that help?
TFSA grows tax-free, and withdrawals are also tax-free.
So it acts like a personal pension.
Exactly, with more flexibility than CPP.
How do childcare expenses affect compensation planning?
They are very important
Why?
because only earned income allows child care deduction.
Dividends do not count.
Correct.
So what should we do?
Add minimum salary to unlock the deduction.
Even if dividends are preferred.
Yes, sometimes a small salary saves thousands in tax.
Can business owners pay salary to family members?
Yes, but it must be reasonable.
What does reasonable mean?
It must match market value for the work performed.
What if they overpay?
CRA can deny the deduction and reassess taxes.
So documentation is important.
Very important.
Some clients want loans or mortgages. Does compensation planning affect that?
Yes, it does.
How?
Lenders look at personal income.
So dividends may not be enough.
Correct. Sometimes we increase salary to show higher income.
Even if it increases tax.
Yes, because it helps achieve personal goals like buying a home.
I thought CPP was just for retirement.
It also provides disability benefits.
So salary gives CPP contributions and insurance.
Exactly.
Dividends avoid CPP but lose that benefit.
That is the trade-off you must explain to clients.
What is the bonus strategy I keep hearing about?
Corporations can declare a bonus now and pay it within 180 days.
Why is that useful?
Because the corporation gets deduction now, but pays later.
So it helps with tax timing.
Exactly. It is a powerful planning tool.
It feels like there are too many strategies. How do we choose?
We do not choose one. We combine them.
Like what combination?
Salary for RRSP. Dividends for flexibility, TFSA for tax-free growth, Holdco for protection.
So everything works together.
That is how real tax planning works.
Should we plan based on future estimates?
No. Focus on current year numbers.
Why?
Because tax rules and income change over time.
So we adjust every year.
Exactly. Planning is continuous, not one time.
This was a lot to take in. Can you summarize it for me?
Sure. Compensation planning is about combining strategies, not choosing one. Always consider short-term tax and long-term goals. Understand client situation before suggesting anything. Use salary, dividends, TFSA, RRSP, and corporate structures together. And review the plan every year.
So the goal is not just saving tax, but building wealth.
Exactly. That is what makes you a real tax advisor.